Hello, everyone. I'm glad you could join us as part of our ongoing series of financial education events and special market updates. And today we're joined by Philip Petursson, the Chief Investment Strategist for IG Wealth Management. Philip is a frequent commentator on various business and mainstream media outlets, speaking to all things related to the economy and markets, and we are very fortunate to have him join us here today. So, Philip, welcome, and thanks for taking the time to chat with us about current market and economic conditions.
Dwayne, thank you for having me. It's a great pleasure to be here and speaking to you and everyone today.
Very good. So, Philip, there's no question that recent market volatility and economic uncertainty has attracted the attention of both business and mainstream media. And when that happens, it's always natural to wonder if we should be worried, and more specifically, if our financial plans are going to be compromised in any way. So to get started, maybe I'll just have you to speak to some of your high-level observations regarding market conditions as it relates to our long-term plans.
Certainly, Dwayne, every time that we run into volatility like we've had so far this year, it stokes the fear within us that maybe there's something more to the market that we're missing. But the truth is, the volatility like this is quite normal. Going back over the last 40 some odd years, we tend to see downside in the marketplace of an average of 14% on the S&P 500. And so this year has been a little bit deeper than that, but nothing out of the norm. But immediately people's thoughts turn to, well, what about the war in Ukraine? What about all this talk about we're hearing of inflation? What about the central banks raising interest rates? Doesn't that mean that a recession is coming? The recession never starts with the markets falling, right? Usually that comes after other signals. And so when I look at the environment that we're in today in the United States, Canada could be a little bit different because we're so dependent on housing for our economy. But how does that interact with our investment strategies? It doesn't. There aren't Canadian home builders listed on the TSX. Our index is very much global in nature. So really, we want to focus on what's happening in the United States, what's happening in other areas around the world. And the data would suggest that, yes, we are slowing, but not to the point of recession. So we can probably put that aside. And the other thing, Dwayne, is every time that I hear all over the media people talking about a pending recession, we're probably not going to get one. It's the the Monty Python sketch. No one expects the Spanish Inquisition, and that's it. No one expects a recession, especially when all the talking heads are saying we're headed towards one. We're probably not, and that's what the data that I look at would suggest. So back to the market then, this market volatility is actually quite normal. And let me just set this up. At the beginning of the year, valuation in the United States was quite high. And I would say it was overvalued. We wrote about this in our 2022 outlook. It had the potential for a correction, but markets can stay overvalued for years before anything happens. And often you don't end up with a correction. The markets just work themselves out of this overvalued nature as earnings continue to grow. In this case, it's been a little bit more disorderly, uncomfortable. We don't like it. But it's no different than what we saw in the fourth quarter of 2018. Where the markets were down 19.7% over a period of almost 4 months. This is quite similar. It's gone a little bit longer, but feels very much the same. When interest rates are high or moving higher, when inflation is moving higher and we're already overvalued in the equities, there's the potential for a correction like this. That's what we have. But is it anything we should worry about or panic about? Not in my mind. In fact, I think it's something that we should take advantage of.
Yeah, great points. And you mentioned inflation as something that is becoming more evident, and we're all starting to feel the pinch of higher living costs, and it's becoming more of a real concern for a lot of us. Based on your experience, how do these cycles typically resolve themselves, and over what time period might that occur? And is there anything we should be considering with respect to our plans?
Well, it's a great question. So how we got to this higher inflation in the first place was all of the support out of the Bank of Canada, out of the federal government during the COVID lockdowns, kind of flooded the Canadian economy and US economy, global economy with cash. When you put more money into the system, one of the consequences of that is higher inflation. So that's what we have right now. It will, as things just all normalize, right? As we continue to absorb this excess cash, the inflation will start to come down. In fact, that's what we're seeing right now. If you look at the April inflation versus March, it was only 0.1% higher in Canada on a year-over-year basis. And in fact, the month-over-month came down. So it looks like we might be peaking and things are going to start to get back to normal over the course of the next, say, 12 to 24 months. Inflation doesn't come down immediately. It's like a slow-moving locomotive. It takes a while for momentum to build, and it takes a while for that momentum to slow. What we should be thinking about in our portfolios, though, is how do we hedge this inflation? And in fact, one of the if inflation is here to stay at higher levels, meaning 3%, maybe 4% for the next number of years, well, one of the better ways to hedge against it is actually through equities. And as companies have pricing power, they can pass on rising costs of inflation to their customers, and therefore maintain that kind of profit growth, dividend growth, and share that with us, the shareholders, over time. So one of the better ways to hedge against inflation hasn't always been gold. It actually has been equity markets.
Yeah, again, great points. I oftentimes suggest to clients that anxiety comes from uncertainty and not knowing for sure. And in many cases, we naturally try to reduce that anxiety by taking some action of some sort to better control the situation. And in your view, I'm wondering if this current episode of uncertainty is a call to action of any sort, or do our managed portfolios take these cycles into consideration?
Great question. So I would say the call to action is take advantage of the opportunity in front of us. And that is historically when the markets fall into a correction. That's a drop of greater than 10%, but less than 20. When you hit that 10% mark, it's to our advantage to start taking advantage of buying that market. The 1 year forward return tends to be positive 90% of the time. So there's a high probability that we'll see the markets gain from these levels May 2023, between now and May 2023. Again, this is a normal correction. So that's something that we recommend. Often, though, Dwayne, what happens is clients do the opposite. And I've been tracking investor behavior in the United States since the late 1990s. And what investors do is they sell at the low. They panic, they see the markets down, they open up their statements, they see the markets down, 10 to 20%, and they say, we need to get out of here before it gets worse. Yet these were the same clients that as the markets are up, 20%, they're saying, we need to buy more of this. The market is interesting in that we should be doing the opposite of our instinct. When it seems so easy, when people are posting on Reddit boards and Wall Street bets and opening up Robinhood accounts in the United States, and you're seeing all those ads on TV saying, oh, well, it was so easy for me to do it. I just hit a button and I bought stock. It's probably the wrong thing to do. Right.
Right.
When my good friends who know what I do for a living are bragging about the stocks that they just bought to me, it usually signals that it's top of a market because there are other elements to it. No one's calling me now bragging about how much money they've made. And that usually is the sign that, okay, we're near the bottom. And my colleagues and I often have a saying, if the thought of putting money into the market makes you sick to your stomach, it's usually the right thing to do. As odd as it might seem, it's usually when it's so easy, it's usually the wrong thing to do.
Yeah.
To your second question, in terms of, well, what are we doing in the portfolios? The program managers of the iProfile funds, for example, and the underlying portfolio managers are always adjusting the portfolios. They are in a constant state of rebalancing and reallocation to the better opportunity set. So, for example, some stocks are down as much as 60, 70, 80%. Not all of these would be an attractive buy today, but some of them might be. That's where our bottom-up active managers will look at their portfolio and say, what is my upside potential based on the valuation that I see over the course of the next year or 2 years? And that would then say, okay, maybe we should sell stock A that has held up very well in this environment to buy stock B that's down 20 or 30% but is trading below the intrinsic value of this company. Other things that are going on is when I talk about buying the market, often people say, well, that's great, but I'm already fully invested. Well, this is where asset allocation comes in. So if you own bonds as well as stocks in your portfolio, as many of our portfolios do, well, we're reallocating. We're selling some of those bonds to rebalance into equities, or think of it as dollar cost averaging without having to commit new capital. We're using the capital already there to buy low for a better position in front of us.
Yeah. Terrific insights, Philip, and hopefully your words bring some comfort to those who are feeling a little bit of anxiety these days. So really appreciate you spending some time with us and shedding some light on current market conditions. I would add that your recent series of podcasts entitled "The Living Market" are tremendous, and kudos to you for providing a really nice, bite-sized, concise way to address market activity on a fairly frequent basis. So I would encourage everybody who's listening today to check out Philip's podcast series entitled The Living Market, and it's available on most standard podcast platforms. So thanks again, and really appreciate your insights and taking some time for us today.
Not a problem at all, Dwayne. Happy to do it.
Thanks, everyone. Have a great day.